Investing in the stock market is hard. It feels like there is so much to learn about how everything works. It is nearly impossible to keep up with investing news, and to top it off, everybody's financial lives is different, so there is no one-size-fits-all rule. So this means that millions of investors either make the mistake of not starting to invest at all, or they start investing and make so many mistakes that they could potentially lose a lot of money. So I'm going to show you the best ways to make investing simple, so that you can invest stress-free and reach financial independence quicker than you ever thought was possible. But to first show you exactly what not to do, we're going to learn from me. Because once upon a time, I was a horrific investor, and I've lost my fair share of money because I simply did not know what I was doing. But what's weird is that now that I've figured it out, I now spend a fraction of the time on investing compared to what I used to, but I am 10 times more successful. So let's figure out where things were going wrong. Well, it all started when I downloaded Trading 212, like everybody else who was bored during lockdown, and I started investing in a random collection of individual stocks. But little did I know, I'd already made a critical mistake. When I wasn't randomly guessing which stocks would do well based on the shapes of the past returns graph, look, you laugh, but we've all been there. I would have to spend a lot of time doing analysis on every stock that I thought about investing in, and nobody knows how to do that properly when they start investing. Then, because I wanted a diverse portfolio to spread my investment risk across a few different stocks, I suddenly had a collection of 10 to 20 stocks that all needed to be individually analysed on a consistent basis. And ain't nobody got time for that. Plus, because individual stocks are inherently very volatile, as in their prices move up and down a lot, I was spending most of my time watching my portfolio of value go up and down throughout the day. But not only is this very stressful, it is also a waste of time. And it makes it very difficult to maintain a long-term investing mindset, which is crucial for investing success. So how did I fix this? ETFs and index funds. By investing in funds, you can invest in thousands of stocks at once with a single click, making it unbelievably easier to get the diversification that you're looking for. Also, these funds often track entire markets or indices, meaning that you don't have to worry about all of this individual stock analysis, and you don't have to worry about the risk of an individual stock not performing well. In fact, investing in the entire world is a proven strategy, as this data shows the growth of £10,000 in the MSCI World Index from 1978 to today, with the returns averaging 10.76% per year. When you take into account average inflation rates over this period at 3.5%, that leaves you with 7.22% on average per year. Even Warren Buffett himself has stated in his will that he's going to leave his wife money, with 90% of it allocated to the S&P 500 and the other 10% allocated to short-term securities. So do not underestimate investing in funds due to their simplicity. They can offer excellent returns with minimal stress. The next bad habit that I had to get rid of, which was very much related to all the individual stock investing that I once did, was reading too much investing news. We've all been there. Downloading different investing apps, scrolling through article after article, trying to find that golden nugget of information that is going to make us rich, or trying to look out for warning signs that are going to save us from making a critical mistake. But has this really ever helped us? In fact, this whole process just makes us more anxious, it makes us more likely to stray away from our long-term investing plans, and worst of all, it makes us trade more often. And research has shown that frequent trading, on average, correlates to lower investing returns, as investors rack up unnecessary costs and miss out on key market growth. So to counter this, I actually ended up deleting my investing news apps, or at the very least, I simply turned notifications off. This stopped me from stressing about investing because I wasn't bricking my pants every time another doom and gloom article popped up on my phone. And I also spent much less time on my phone researching so that I could actually spend more time doing other stuff. But I do get it, because the finance world is interesting and it's nice to keep up with what's going on in the world. But at the same time, you can't let the investing news have an effect on your investment decisions, because it will more than likely have a negative impact on your investment returns. The problem is that even if you do try to remain neutral and unaffected, the news will subconsciously work its way around your brain and impact your investing behavior. For me, ignoring the news helps to keep me invested, which brings us on to my next bad habit, which was wasting too much time worrying about the best time to invest. Whether it was because of some gloomy investing news article or just a terrible week in the markets where all that you could see was red, I would often waste so much time waiting for the perfect time to invest my money, so that I wouldn't miss out on the best growth. Because let's face it, it does feel crap when you invest some money in the stock market and the day after there's a bit of a crash or the market tanks. You feel like an idiot and you feel like it could be avoided. But in reality, by waiting around, all that I was doing was wasting precious days that my money could have been invested in the stock market. I was missing out on long-term growth. Investing on the perfect day, every week or month, is not going to make you rich. But investing consistently every single month, even in market downturns, is what is really going to make the difference. If you don't get enough money into the markets in the first place, then you're never going to be able to reap the full rewards of compound interest over an investing lifetime. Your deposits matter. The best way to get on top of this is to set up a direct debit with your investment provider and automate the deposits so that you don't have to log in to do it and you don't even have to think about it, which removes all friction from the depositing process. Now, if you haven't noticed this pattern yet, it seems that investing is actually nothing like any other skill, activity, or hobby that we do as humans, because normally, the more time that you spend doing something, the better you get at it. You run more, you get fitter. You play more chess, you get better at it. You watch more Prime Minister's questions, you get better at spotting when people are lying. You get my gist. But when it comes to investing, the more time that we actually spend investing, the more we tend to overcomplicate things, which can have a negative impact on our investing returns and our stress levels. This data shows the average returns for a range of asset classes and compares them to the average investor. The S&P 500 had an average return of 8.2% over the 20-year period, while the average investor return was sat at 2.1%. We are our own biggest enemy when it comes to investing, so the more that we can get out of the way and automate the process, the better. The next investing facade that can make investing seem much more difficult than it needs to be is the idea of these multi-asset class portfolios that offer the perfect blend of diversification. You've probably seen some recommended, along the lines of 40% stocks, 20% bonds, 15% real estate, 10% gold, and 99% crypto. Now, I'm not saying that multi-asset class diversification is such a bad thing, but the problem is that these are actually quite hard to implement for the average retail investor, as you need various investing platforms and all of the fees start to add up on top of each other. The truth is that you don't need to make it this complicated. Some of the best investors in the world recommend that you only need 2 asset classes to build your portfolio: stocks and bonds. And in some people's cases, stocks alone will probably do the job. And the beauty of this is that it can all be done on one platform, making your life easier and keeping your costs lower. In fact, if you choose to invest with InvestEngine, you'll be investing in one of the lowest cost ETF investing platforms in the UK, which is so simple to use, making it easy to benefit from everything that I've mentioned in this video so far. For their DIY portfolios, you pay no account fees or no trading fees. You only pay for the ongoing charges of the funds that you choose to invest in. You can easily set up a stocks and shares ISA with them, and the features are great, including direct debits, a setting that automatically invests cash in your account into your selected funds, as well as an automatic portfolio rebalancing button, making investing so easy. If you sign up using my link below, you will receive £25 when you deposit your first £100 onto the platform. Also, if you deposit £10,000 into an ISA or transfer over an existing ISA worth over £10,000 before May the 2nd, you will receive an extra £100 bonus. I'll put the terms and conditions in the description below. Cheers. But the thing is, if you really want the best investment returns, then making investing simple is not quite going to be enough on its own. You also need to understand how best to manage your investing taxes. Otherwise, you could end up losing tens of thousands of pounds in the long run. And that's why you really should watch this video here, where I show you the best investing tips that will make sure that you pay as little tax as possible, so that you can reach financial independence as fast as possible.